Welcome, everybody, to Crossing the Line with Greg Heym. Isn't it great that my name's in the title?
Sure.
Thank you very much. Where each week we dig into the latest news on the economy, housing, and occasionally make fun of New York sports teams, but to be honest, they're asking for it. Except the Rangers, who they came back and beat Florida in a shootout this weekend. Number one in the East, or our best hope at a New York title this year, for sure. Today's March 25th, a little cold this morning, and it's our 18th episode, and in keeping with trying to find song lyrics with titles, so we're 18 and we don't know what we want. Now that's paraphrasing Alice Cooper's song, I'm 18. It's the best I could do. We'll see what we come up with for 19.
You did great.
And in case you haven't guessed by now, I am Greg Heym, chief economist here at Brown Harris Stevens and author of The Line, the blog that is the basis for this show. We have Hannah, as always,
Hello.
Re-equipped with her soundboard again. Enjoyed it last week. It's our moment of zen for the morning. And Ray and Lena, always great to have the team together here at beautiful Studio 1873, beautifully decorated by our very good friends at the Everet. Again, always trying to be informative, concise, entertaining, and edgy all at the same time. If you have any questions or feedback, CTL at BHSUSA. And before we start the show in earnest, because my wife probably won't watch all of this.
Give her more credit than that, please.
Thursday is my anniversary, so I want to say happy anniversary to my wife, Joanne. 26 wonderful years. She
26.
tells me that all the time, how lucky I am to be married to her, and I guess she's right. Plus, I'm smart enough not to argue about it, but happy anniversary, darling. I love you.
Very sweet.
All right, so let's get right to the line items.
Yes.
What's batting lead off today?
Well, the Federal Reserve left rates unchanged this week, but that really didn't surprise anybody. Did it surprise you?
No, they pretty much said, leave us alone. March had been the target date markets were looking for the first round of rate cuts. The Fed basically said, forget about that. You didn't eat your meat, so you can't have your pudding, as Pink Floyd might say.
Okay.
And, that makes a lot of sense. The economy does not need rate cuts now. And they haven't touched rates since July, so they've kind of been in this holding pattern for a while. So one of the things the thing that's getting the most talk is a couple of times a year they issue their economic projections. And since it's the Fed and they base their decisions on economic data, it means a lot. And there's something in there that is referred to as the dot plot. I know, what the heck is that? Basically, it's their forecast for the federal funds rate for this year and the next couple of years. Why that's important is that it is forecast to be 75 basis points or 0.75% higher by the end of this year. Lower at the end of this year. What does that mean? That means they expect 3 rate cuts, right? And that made everybody happy when they heard that. It's like 3, yippee. But remember, this is no guarantee. There was supposed to be another rate hike last year at the end of the year, and they didn't do it. So, but let's have a little bit of fun with this. They have 6 meetings left this year. One is the April-May meeting. I don't know why they started meeting on the last day of April and carried in the first day of May, but maybe someone knows the answer to that. June, July, September, November, December. Markets are betting June would be the first rate cut. I don't think they should do that. I can't say for sure it isn't, and I'll give you 2 scenarios in a second. But just remember, the economy is still very strong. Inflation, depending on how you look at it, is still much higher or higher than the Fed forecast. If you look at PCE, core PCE, their preferred measure, it's running at 2.8. CPI is running a little higher than that. It's irresponsible to give the economy rate cuts it doesn't need. Consumer spending surprised to the upside. The forecast for first quarter GDP is looking at about 2% growth. That's not an economy that needs support. And as I mentioned too often on this show, for those of you waiting for mortgage rates to go down. What the Fed does with this rate has no direct correlation to mortgage rates. So if they decide to cut this rate 25 basis points, mortgages are not going to become 25 basis points cheaper necessarily. But it is very important when it comes to credit card debt, other variable rate debts, short-term debts, obviously very important.
This beautiful set here at Studio 1873 is brought to you by the Everet. The Everet provides full-service staging and furniture rental solutions in the New York area. For more information, please visit us at staging.theeverset.com or email us at staging@theeverset.com to request a free proposal.
So I think there's two options to the Fed here. The smarter one might be, well, let's just do it, the last 3 meetings and, get it done that way and not rush it. Now, these changes do take about 6 months to a year to have any real impact on the economy. And look, inflation is trending in the right direction, but I think to reset and go in the opposite direction is very risky. So that's one scenario. But remember, there is an election in November.
Right.
So this is the other option, and maybe this is the one I might bet on a little bit more now that I've thought about it. They give the market what they want in June. They say, all right, we're going to throw you a 25 basis point bone, so to speak. And then they do the November and December because those would be after the election. I think the next meeting, the November meeting is the day after the election, if I remember correctly. So that might be a way to hedge a little bit. So again, we mentioned their economic projections, which actually went up. The last time they did them was back in December. And now they have economic growth for this year at 2.1%. That's up from 1.4%. So now they've grown more optimistic on economic growth. The core inflation is expected to be 2.6% this year, a little bit higher than the December estimate. So we'll see what happens. Every time we joked about the election and how nobody's paying attention. Wall Street doesn't care because Jerome Powell is the most important person in financial markets right now. Should the Fed? I guess it must be weird for people that haven't lived this or thought about it, that all of a sudden we're living and dying with what the chairman of the Fed says. Somebody who maybe a lot of people don't even know who it is a lot of the time. But when you go through a period of high inflation, all of a sudden, he gets a lot more, or she gets a lot more play in the press and listen to a lot more. So that's the latest on the Fed. I'm not going to slam them. This was the right move now. I've done enough of yelling at them for getting inflation, letting inflation get out of control in the first place, but I have moved on. All right, second one.
Yeah, Wall Street bonuses. They totaled a hefty $33.8 billion in 2023.
Every year we get told, and people in financial industry tell me this, forget bonuses this year. There's going to be no bonuses. I was like, but Wall Street had a really good year. I don't care. They're not getting any bonuses. $33.8 billion, virtually identical to 22. And to paraphrase Sebastian Maniscalco, that's all in cash. A lot of people think there's options or they get deferred compensation. No, this comes out now because now the state comptroller who gives this estimate knows how much these people have made and can make a good estimate of what amount of that was in bonuses. The average bonus did dip a little bit to paltry $176,500, but that's not a big deal. So since we're really into housing here, since this is a real estate company and we are headquartered here in New York City, how much money is $33.8 billion?
Why don't you tell us, Greg?
Well, it's enough money to buy all the New York sports teams and have money left over, but you could buy every apartment for sale right now in Manhattan, cash, and still have $11 billion left over for something else. What are you going to do with that $11 billion, Hannah? You could buy every book ever written probably, so that would feed your
I would dabble in
addiction
the antique book market, maybe get a yacht, couple, maybe invest. Isn't that something that everybody says that you should do with a lot of money?
Well, if once you have the $11 billion, do you need to invest? I mean, if you ever look at the numbers.
Yeah, I'm going off the radar, by the way.
No.
If I have $11 billion.
That's the fun part. We'd like to have it settled for $11 million or even 11,000 at this point. But, it's fun to think about these. But it's funny. I remember reading an article years ago where they talk about the richest men in the world and how much money they would have to spend per day to actually, lose money because of the interest they get, the money they're making on a daily basis would require them to spend truckloads of money each day.
Yeah.
So, nice problem to have, I guess. But,
yeah.
Just to give you an idea of Wall Street bonuses, so $33.8 billion in the last 2 years. In 21, it hit a record $42.7 billion.
Wow.
But except for that year, you'd have to go back to 2006 for the last time Wall Street bonuses were higher than they are now.
Okay.
So it's a lot of money. And shows you how much money they were making in 2006. It was $34.3 billion then. So all this time about what it's changed, they're not getting bonuses like they used to, and it's nonsense. Every time stuff comes out, it always is better than expected. All right, we have a final item.
Yes, home construction. There was, talk of there being a lack of new home construction. But do you want to get into how it's ramping up a little bit?
Well, see, here in New York City, we're really mad because we had this tax benefit called 421A. That's named after the section of the law, the real property tax law. And it's been allowed to expire. And that drove so much of the development of new housing in the city. And towards the end, it was only for affordable housing. And maybe the state gets their act together. Maybe they don't. But it's not just here. We see in the existing home sales, which we're going to get to in a minute, and we know there's none of that inventory available. So people, we really need new construction. It's the surest way to get housing prices down is to build more of it, right?
Correct.
Interest rates are going to do what they're going to do. That's going to take time, but we need to ramp up production. And housing starts jumped almost 11% in February because February is the coolest month of the year because me and Hannah were born.
It's our birthdays.
It's our birthdays.
National holiday.
You missed it, so next year don't be late with the gifts.
Yeah.
Just so you know.
Yeah.
So it came in at 1.52 million. That's an annualized rate. So if they built that much, adjusting for seasonal factors, we would start 1.52 million homes. That easily trounced the forecast of 1.44 million. So that's really good news. Shovels in the ground. Let's get that housing built. Single family construction hit a 2-year high, and multifamily starts were up 8.3%. So all good there. And then so that's the now, right?
Right.
These homes being built. The future is building permits. And
some good news there.
Right, their highest rate since August. And that's good on two fronts. Obviously, not every permit becomes a unit. Not everything that's planned gets built. But it's not bad news for sure. Most of it does get built. But it's also one of the leading indicators we look at. You ever hear the index of leading indicators for economic growth? Because it's the future. If permits are going up, hey, we're going to have more housing construction. That's good for the economy, which is anywhere from 15 to 20% of GDP is based on housing and housing-related things. So that was number 2 in the list. But then we completed the trifecta of great news on housing construction when we found out that builder sentiment came in its highest level since July.
Right.
So that's good news. It's good news that we're building homes. We have a huge problem with housing affordability and housing supply. And, it creates jobs and it creates hope for those first-time home buyers, no matter what generation they fall in. I don't want to isolate any of them. But we did talk about the frustration a couple of weeks ago of people thinking buying a home is going to be out of reach, and that's something, that they're really worried about. So it's good news that the that we're ramping up development, and they're optimistic. And again, I think home builders, just like a lot of buyers out there, are accepting that rates are going to remain elevated, at least for now, and life still has to go on.
Right.
But remember, they borrow money too, home builders, and their rates are higher as well. So it's good that they're getting things going and moving in the right direction. So that was the line items. And before we get to the line up, our other line-related thing on the show, isn't everything about lines here, we have to break for this important message.
What do you really need to know about buying or selling a home? First, it's serious business, and it's complicated. There's a lot of money on the table, and emotion too. You need an agent who knows the ropes. So, whether you're buying or selling your home, work with professionals who have a mastery of the craft.
And we're back. So now, Hannah's favorite part of the show.
Of course. Well, everyone's, really.
Isn't every part of the show their favorite part?
All right. Okay. We can share it.
They can always email us and tell us the favorite part. Some people might say when it ends. I don't know. But what is our first topic in the lineup today?
Well, speaking of the lovely month of February, home sales during the month of February spiked 9.5%, which was the largest monthly gain in a year.
That's good news, right?
It's great news.
And it sounds, it's funny. I wrote the line a little early because of other things that I had to do before this data came out, or I probably would have thrown it in the blog as well because it is good news. But, just like any good economist, I have to, kind of ruin the joy a little bit, but we'll get to that in a second. Big surprise, analysts were expecting it to decline, 9.5% increase just in the month of February. As you said, biggest monthly gain in a year, but existing home sales are still 3.3% lower than a year ago. Going in the right direction. What fueled this? Well, one thing was that inventory was up 6% over the past year. We keep saying we could sell a lot more homes if we had more homes to sell, and that happened, so boom. Unfortunately, the increase in inventory didn't bring prices lower. In fact, the median price is up 6% from a year ago at $384,500. And here's an interesting stat. 20% of the homes that sold above asking price. So it shows you the FOMO that buyers have.
Yes.
You go through a hot market. I bought in a hot market. You do get tired of losing out because sometimes you don't get a chance to come back with another offer. And finally, you just say, okay, let's just get this done. So all of that sounds good, right? Housing, people are accepting reality, and they're making a big decision that they'll never regret, I'm sure. But now let's say why we shouldn't throw the party just yet.
Right.
A lot of these deals were signed when rates fell at the end of last year, right? You sign a contract, a couple months later you close. Remember, January's number was a good number too. Since then, rates have gone mostly up, as they did last week, unfortunately, ruining our streak of declines. But see, even when the Fed does nothing, mortgage rates move. So that hasn't been great. Now, we talked a couple of shows ago about pending home sales. That's when contracts are signed. It's like a real-time indicator, so to speak. They fell 5% in January. So while the past, which is what closings are, looked really good for January and February, we're more concerned about what March and April are going to show, because the pickup in rates obviously has had an effect on contract signings, at least through the beginning of the year. We'll see what the February pending home sales numbers show. That'll be another couple of weeks till we get that, or actually maybe another week or so, sorry. So bottom line is, this is great news that so many people found a home that they've probably been trying to get for a long time,
Right.
and that inventory is up and that people are moving forward. But, there are a lot of reasons to worry about how long this is really going to last, because of the increases in rates so far this year. So we'll see. There's your little dose of reality. Sorry to throw shade on such a happy report, but yeah, no, it's
unbelievable.
Don't boo me, boo the mortgage rates. They're the ones that rose. So we have one final item that kind of ends us on a happy note and brings everything into focus.
Yes, the Dow closed 300 points lower Friday, but notches best week since December.
See, that's the big headline.
So bring us home with that.
Even after a rough Friday, all three major stock indexes posted gains last week, and you said the Dow having its best week of the year.
Yes.
And that's great news. I always say all the time, it's the best mood ring you can find, the best indicator of people's confidence and expectations for the future, because you put your money where your mouth is, right? That's the expression. And look, they loved what Jerome Powell said after the Fed meeting. Like, you're not getting it now, but you got 3 coming, so that's enough. Just enjoy that and be happy. So they are happy. Now we'll start to see how they feel when we start to get the March data coming in. The employment report and the inflation, that'll be a while. But, things are looking really positive in most cases, except, housing's still a struggle. We'll see. Maybe the momentum will continue. Maybe that $33 billion in bonuses will go into the housing market. That's what you should do with all that money.
That would be crazy and amazing.
I mean, you think about it. You could buy every apartment for sale here in New York, of which there are, I forget the last count, probably about 7,000 of them, and still have $11 billion left over. So then maybe you could buy some properties in New Jersey if you wanted to.
Get a collection of pinball machines or something.
I miss pinball machines. We talked about shrinkflation last week. Pinball machines when I was a kid used to give you 5 balls, and then all of a sudden it was 3 balls. And
I don't think anyone is upset about this except you.
It's my youth. It shows how old I am.
All right.
It's Monday morning.
You should write a strongly worded letter to the Pinball Federation.
Is there still one anymore?
There could be.
I don't know. But if it wasn't for pinball, the Who Tommy might not have worked out the way it did, and one of my favorite albums of all time. Well, that's it. It seemed to fly by. I want to also mention on Friday, I got a chance to sit in with some old friends at Vincent's Steakhouse in Montauk. That was the restaurant. It was before that was a place I first started sitting in and playing, live again. And the 2 guys that do the music there, Vinny Sharafalo and Tom Smith, are the reason that I'm a gigging musician now. If they hadn't given me a chance to sit in, Vinny introduced me to my guitar teacher 4 years ago, I would not be doing what I'm doing now, and I'm forever grateful for that. So Thanks, Tom and Vinny, for all the support over the years. And it's always fun to go play the old tunes.
Yes, of course.
They were old before I was born. Now they're really old, but that's the fun part of all that. Well, that's our show for the week. Thank you, Hannah and Ray and Lena. And most importantly, thank you to all of our listeners and viewers out there. Without you, we wouldn't get to do this. Tell your friends, like and subscribe all of the great podcasts here on the More Network. And by the way, you'll see me on the latest one from Candace and Melissa, The Build-Up. I made a pop in. We're going to do like variety shows now with all the podcasters getting together, and it's going to be a lot of fun. So
it's a great watch.
I saw the footage. I thought I was outstanding, but I may be a little biased.
Probably.
We'll take a vote on that next week. But thanks again, everybody, and we look forward to next week's show. Have a great week.